please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
A second bout of selling has definitely started. So either somebody tried to cover short after the first 5 minutes of selling, or even tried a long trade, but it's not worked. That's gotten sold into, and now we have all the indices at the lowest point of the morning. We are only speaking of about 16 minutes of trading, but this is the lowest point of the 16 minutes of trading. 1.4 knocked off the bigger indices, Sensex and Nifty, almost 2% gone on the bank Nifty. That's 460 down to 23,670, and the mid-cap index down 2.25, 425 points down. Sanjeev, good to have you back with us. Well, is this a falling knife? What is your analysis in fundamental terms? Are the markets getting to a point where you will try buy trades?
So you have to look at market always on the basis of stocks. There's nothing like a market. There are several underlying components. So the challenge here, which has been always the case for the last at least 12-24 months, is that the good quality names, they continue to be expensive. They haven't really fallen. Whether they are the consumer staple or the discretionary names or the private retail banks. So they are still on the higher side if I look at any, valuation parameter, long-term averages, etc. Whereas the macro uncertainty has definitely increased over the last 6-7 months, and probably, getting worse by the day. So somewhere, some of these factors should have got factored in the valuations of the high PE, the better quality names, but that hasn't happened really, and they continue to be on the expensive side. What's become cheap are the cheap stocks anyway. Stocks which had a lot of value to start with. Things like some of the the so-called the private corporate banks, some of the metal names, etc. But they're getting cheaper by the day, and there's obviously no interest in buying these names till the time you see some bottom of the market or some sort of sentiment coming back. So the question is, what do you do in a market like this? It's very, very difficult because clearly, we haven't seen the worst case situation play out. Firstly, things have become quite bad on the macro side. But of course, over the last 2 months, domestic political uncertainty has also increased. And now, all the global trade-related issues are coming to the forefront. And obviously, that has also dampened sentiment. So that's the whole challenge over here, that it doesn't look like the worst case situation is factored in. On the other side, if I look at a situation where things start improving, in the sense, let's say over the next few months, you start seeing GST revenues picking up, oil prices cool off to, let's say, $60 a barrel or lower, then suddenly India's macro starts looking a lot better, and many of these names which have been hammered in the, the private corporate bank space or metal names, etc., they could probably bounce back. Over the next 1 month, anyway, we are going to see some progress on the resolutions of the NCLT1 cases. And if they go ahead smoothly, you see, some of these deals getting closed, then you could actually see some sentiment changing for some of the stocks which are affected by, some corporate resolutions going forward. So it's a very tricky situation. It doesn't look the market is factoring in a worst case situation. It doesn't look like it is factoring in a better scenario if some of the macro situation starts reversing. Somewhere it looks like we are in the dead zone for now, and unless until we see some decisive movement on the macro either way, either it becomes worse or becomes better, very really hard to take a call at this point in time.
Okay. Sanjeev, over the last 3 or 6 months, what we have seen is IT has remarkably outperformed the banks. Before that, of course, we had seen the financials weight go up to 42% in the index. Do you think there's some more adjustment to be made in that particular aspect, or do you reckon that it's now perhaps a good time to once again be looking at financials after the kind of decline that we have seen?
See, it depends on the time frame you have. Over the next 1 month or so, I don't know, things could probably become worse. If let's say you have a full-blown, trade war between between US and China. Let's say if China starts dumping US treasuries, what happens to world sentiment in that case? So on the other side, as I was saying earlier, if let's say the situation is contained on the global front, and on domestic side we see some improvement in the macro plus resolutions of some of the bad assets, then you could actually see some of the banks which have been hammered over the last 2 months, bouncing pretty sharply. So it depends on what time frame you have. Over the next 1 year, if I take a call that things will improve in India in terms of the macro improving, political uncertainty going down, or hopefully no untoward political incident, as also some of the earnings recovery and the economic recovery that we have been talking about, that plays out unexpected lines, and you could actually see, some of these bank stocks bouncing back pretty sharply, and IT may not be performing in that case. So IT looks like a temporary hiding space. But here's a thought. I mean, what happens if tomorrow the U.S. government wakes up and says, "Oh, we are going to put some tariffs on IT exports from India"? Who knows where the world is headed? I mean, I think we are in the hands of some mavericks out there.
Absolutely, that's what we were discussing earlier in the show as well. IT could be, the next one for punishment. But Sanjeev, just to take that point forward on banks, it's hard to catch, the market, the bottom of the market, right? So if someone has, say, a 2 or 3 year long-term horizon, do you think some of these corporate-facing banks, ICICI Bank, SBI, that have corrected so sharply, 20–25%, are good buys now?
Definitely. So if you look at an ICICI Bank, for example, assuming that we are going to see progress on the asset resolutions over the next few weeks, and I think we are pretty much at the end of the asset resolution process as far as some of the steel companies, etc., are concerned in the NCLT1 case, then I see tremendous value over here. If I take out, let's say, 100 rupees or 110 rupees as a fair value of all the non-bank businesses of ICICI Bank, and the stock is effectively available at, let's say, 160, 170 rupees now, which is pretty much the adjusted book value for March 20. So it effectively is down to one-time March 20 adjusted book value. It's probably on a March 19 basis. If I do the same math, it will be more like 1.2, 1.3 times. So how much more cheaper should a bank become before people start looking at it? SBI on a similar basis would probably be less than 1 now, 0.8 if I got the math right over there.
Okay. Sanjeev, there have been other problems also for the market in terms of, the public sector banks probably now unable to lend, as well, of course, political uncertainty. So given all that, is the high of this market, I mean, assuming the global market bounces, are we still going to see Indian markets limp along? How much gains can you make at all, even from current levels?
See, a lot will depend on how the macro pans out from where we are, and I keep coming back to the same point. Unfortunately, nobody has any great handle on the macro. I mean, the first thing to watch out for is what happens to GST revenues over the next 2–3 months. Currently, we're running well short of the 2019 targets of the government. We require somewhere about 1.1 trillion rupees of monthly GST revenues. We are nowhere in that range. But over the next few months, if because of implementation of e-way bill system, matching of invoices system, etc., you start seeing GST revenues picking up, then at least the bond market may breathe a sigh of relief, and you could see some bond deals in India starting to cool off to some extent. So that should be a positive. If inflation does not surprise on the upside as on expected lines, and the RBI does not need to act in terms of raising rates. So that should again be a positive. And lastly, if oil prices cool off, let's say to $60 a barrel, then the pressure on the current account, BOP and rupee will also, start coming off. So all these things play out, then I guess, things could actually start looking up. As I was saying earlier, anyway, we are starting to see some signs of economic recovery. And hopefully you don't see, 1 or 2 more major scandals coming out of the public banking system. And hopefully, this PNB thing is more of an isolated problem, not really a systemic, issue. Yeah. So if you see all these variables, working in your favor, then maybe you could see the market, recovering from where we are.
Okay. Sanjeev, so last year you said you have cleaned out the mid-cap portfolio. You said there's not a single stock in your universe which is at value zone. Is it time to start constructing a portfolio list again?
No. First of all, let me correct that. I never said there is not a single stock in the value zone. Let me be very clear about that.
No. I mean, maybe in your research universe.
Putting mouths
maybe in your research universe.
No,
Sanjeev.
not at all.
Okay. So
not at all. Not at all. I think we should. Yeah, exactly.
Okay. So let's talk about the mid caps then. Right now, are you looking at building a portfolio, especially considering that the stocks have fallen from the highs?
See, again, you have to look at, stocks. I mean, there is nothing like, a portfolio or anything that we keep talking about. We have to look at individual stocks always. If you see a bunch of, good stocks available at decent valuations, you buy them, But at this point in time, as I was saying earlier, I still don't see sufficient value in the stocks that I really want to own in the consumer staple names or the discretionary names. I mean, they have come off a little bit in the sense they haven't really performed over the last 1 year or so. If you look at many of the consumer staple names, they have been pretty much in this zone only. and there has been some time correction over there.
Okay.
So valuations are getting a little bit better on 2020 basis. Some of the better quality consumer staples have come down to low 30s now, which is starting to look a little bit more interesting. But in general, I still think valuations on the higher side. Maybe another 6-7 months, prices don't go anywhere. Maybe that's the time to look at some of these names.
I also wanted to chat with you, Sanjeev, about metal names like Tata Steel, because I noticed in your note you've removed JSW Steel and allocated 100 basis points each to Hindalco and Tata Steel. Tata Steel has just announced that they've become a successful resolution applicant for Bhushan Steel. So the problem here is that there is a fear that they could be paying a lot for the asset, and what is the pressure that it could do on the balance sheet, etc. How do you approach it at a time like this?
So you have to look at these things on a slightly longer term basis. How much are Tata Steel paying for Bhushan Steel? If it is getting the asset at something like 60 cents to the dollar, if you want to put up a new steel plant in India, that will anyway cost you, let's say 100 rupees. Against that, you're putting up you're getting a similar asset for, let's say, 60 rupees. So I think it's a very, well thought of investment in that case. You try setting up a new steel plant in India, it will take you years to set up a steel plant anyway, or for that matter, any project these days. Given the whole amount of challenges for doing, investment in India, still it's not as if, it's a very great place to do business. The government is trying hard, but still have challenges. It will take 6-7 years to, actually put up a greenfield steel plant in the country. So in that sense, it makes tremendous sense for a company like Tata Steel to acquire something which is already available, and that too at a steep discount to the replacement value. So yes, on a temporary basis, you will start seeing debt to EBITDA looking higher, which is what I guess the market is worried about. But from a Tata Steel perspective, that's probably the best time to look at adding steel capacity, especially given the fact that if you look at India, we will reach about 90% capacity utilization by March 2020. India requires steel capacity, so for some of the companies which have strong balance sheets, it's probably the best time to add capacity.
Okay, FMCG stocks, by the way, are still trying to make highs of the morning. Marico, Godrej Consumer. Sanjeev, that space has done well, right? I mean, Lever has been the clear leader, but other stocks have also done well in the FMCG space. Jubilant Foodwork has done well. Your thoughts on the domestic consumption story? You think that's still the space to buy?
At the right value any day, yeah. I mean, these companies will continue to grow for the next 20-30 years. But then I should, be getting at a value which makes sense to me. If I am, going to pay for, everything to discount it today, then probably that's not much, value out there. But if some of these companies, as I was saying, they have come down to about 30 times on the March 20 basis, it's starting to look more interesting. If another 12 months, maybe, if they don't go anywhere, then the valuations become a lot more attractive. Do keep in mind that many of the stocks have actually not done anything for the last 12 months. If you look at the names like Asian Paints, even Marico, Dabur, they have just been stuck in that, in that zone for a fairly long time now. So in a way, there is a time correction playing out over there. I doubt you would see a severe price correction in these names unless until something goes dramatically wrong globally. They will just probably stay where they are, and that's probably the usual hiding places in the market, which is looking very weak, or things have become pretty volatile.
Banks, especially the retail ones.
What about them?
No, would that also be part of your hiding place?
Well, they have been, no? I mean, again, these are companies which will deliver for the next, 2-3 decades. That's the way I look at some of the private retail banks. So, again, what's the right price to pay for them? If they are available at 2.5 to 3 times price to book on a 12-month forward basis, you buy them, without thinking about it. Unfortunately, they are more available at about 3.5, which obviously makes them slightly harder to look at. But, those are the hiding places at this point in time. So, if you see, you continue to hold these stocks, you are not going to be, trading in these names that much. You add to them whenever you get the right time. If something happens globally, some of these better quality stocks come off, you go and add to the portfolio. Otherwise, you just keep sitting on them for a fairly long period of time. That's the way you play some of the better quality companies.
Okay, Sanjeev, we'll let you go on that note, and hopefully the next time we speak, the market will be in a better mood and better frame of mind. Thanks so much for joining us. That's the word coming in from Sanjeev Prasad. There is uncertainty across the globe, and to add to that is our own political uncertainty as well. So looks like we could be headed for tougher times. Paul Kitney, the Chief Equity Strategist, Asia Pacific at Daiwa Capital Markets, joins us on the phone line from Hong Kong to discuss all the developments overnight. Paul, good morning from India, and thanks so much for joining us. You know, the investors that you speak to or your clients, what are they indicating? Is this reaction that the market has had over-exaggerated, or do you think that we could be headed for some tougher times?
Yeah, so good morning, and thank you for inviting me on your show. Yeah, I think the markets are, you know, I think extending sort of, you know, what we've seen with the additions to the sort of the lists of tariffs that are being imposed from the US on China to extend to technology products, and in response to that, aluminum, steel, and possibly some agricultural products. Tariffs being imposed by China on the United States. I think investors are looking at this and by extension concluding that there's going to be some form of trade war. Now, our view is that actually what we're seeing so far is really sort of a series of skirmishes, or a series of, you know, selected targeted tariffs, rather than a full-scale trade war that would benefit neither the United States nor China. So if we actually look at what the outcomes would be based on some modeling work done by ourselves and also sort of by academia, a trade war would benefit no one, but it would be particularly bad for China as opposed to the United States. So the order of magnitude is much higher for China. So it's not in China's interest to respond aggressively to the United States, but for political reasons, they need to make some sort of response.
Oh, yes. Paul, good morning. What about other economies which do business with both China and the US, emerging economies in particular?
Well, that's a great question. And so I think, you know, the way to look at this is looking at trade account exposure. So in the Asia-Pacific region, just to put this a little bit in context, India's trade ratio, which is just the sum of imports and exports to GDP, is about 40%. That's very much at the low end of the range. We can look at, for example, Hong Kong's trade ratio is about 370%, or Singapore, which is about 320%, or even Vietnam, which is about 250%, which are much more exposed. So those economies in particular that depend much more on trade rather than their domestic economies will be more exposed from an economic perspective. But to your point about markets, you know, I think near term this will affect sentiment overall. But I do think that those particular economies in particular would be more exposed if this bout of trade protectionism does extend.
Okay. Paul, actually, the biggest tit for tat that everyone fears is if China starts dumping US treasuries.
Yes, well, I think this is the one that is possibly an alternative for China. We don't have any evidence that this is happening already, but it's something that they do have up their sleeve. So, you know, when we look at tit for tat in trade tariffs and an escalation of a trade war, the China has more to lose than the United States. But the United States has more to lose if interest rates were to rise. So if China or Japan, say, were to buy fewer treasuries.
Okay. But are we even looking at that? I mean, that would be if global interest rates were to rise, the US 10-year goes to 3 and above because China has dumped US treasuries. Should we even discuss this in the realm of the plausible?
I think in the very near term, I don't think it's terribly plausible. So I would agree with you, but I think it is a credible threat that China has, as you know. China and Japan fund the US's deficit. So I think there's a big misconception about what trade deficits and what trade surpluses are all about, and the differences between, you know, consumptions and savings. You know, the US net doesn't save, whereas there's large savings in Japan and in China. And so those deficits in standard of living in the United States is funded by China. So it's something that can be used as a threat. And it doesn't mean they stop buying treasuries altogether, but there can be this can be a potential tool in the future.
So just to summarize for us, Paul, in your note you mentioned that you would be prepared to add to your equity exposure as this correction progresses. So what are the top markets on your list that you would add to now?
Yeah, so right now, top of the list is China. So we're overweight China. We're overweight India. We're also overweight Korea and Hong Kong. So those are sort of in that particular order would be our countries of preference.
Okay, we will leave it at that. Paul Kitney, thank you very much for joining us and giving us your views on what's suddenly come over all financial markets. A trade war, incipient, expected to blow up, and now suddenly it's cast a deep red across all risk assets. But to be fair, now we are seeing things correcting.
Just wanted to point out, Lata, Titan, for example, is making highs of the day. Jubilant Food, we already spoke about, that's been the strongest stock. That's making the high of the day. And Oil India right now is, I think we didn't address that news as much as we should have because of the global setup. But that gas price hike, so obviously that's helping. So these are few stocks which are still in the green.
2% gains over the last half hour in Tata Power, Titan, Motherson Sumi, NMDC, Infosys, Tata Global Beverages. I mean, they're all still marginally in the red, but it's a 2% gain in the last half hour.
Okay, well, let's move on. Balrampur Chini is one of the, has been in focus this morning, though it's off the early lows. In news earlier, remember the government had scrapped the 20% export duty on raw and refined sugar. Joining us to assess the impact is Vivek Saraogi, the MD of Balrampur Chini. Vivek, hi, thanks for joining us and thank you for patiently waiting by. We had some global news to address as well. We were speaking with a couple of sugar companies yesterday and they indicated to us that because of this 20% export duty on raw and refined sugar, it won't have a meaningful impact either in terms of sales or even in terms of prices. Is that your view as well, that domestic prices will continue to be subdued?
Yeah, good morning. Absolutely correct. There is about a 1/3 loss in export. So just merely scrapping export duty is not doing anything. If you do recall last time when India exported sugar and there was a huge surplus, that is production higher than consumption, government came out with that MIQ scheme which was backed by some kind of a production subsidy. So it's backed by something. Otherwise 1/3 of your realization is lower in the global markets.
Good morning, Mr. Saraogi. Now, what do you think can be potential problems for the sugar industry? Are you staring at a sugar year 18-19 as well, which might mean, higher losses? It's an election year and expecting lower cane prices may be tough.
Yeah, see, they're absolutely correct. So we are looking at a surplus this year. I mean, production is north of 30 million. We are looking at a maybe higher production than this year's production next year. So if you combine this year's surplus and next year's surplus, you're staring at a huge surplus. So I think both the governments would somewhere have to understand that in an election year, you also cannot have the highest ever arrears of cane price in your life. So I think both the center and state need to step in. We have put in our request, we have explained the position. If there is a surplus on the supply side, that's sugar, one would have to take a proactive decision to export it.
Okay.
If export requires some backing from the government and some participation from the industry, I think both have to put in their best. State government might not lower prices, but if they want to maintain the price at 315 this year, if you recall in the past when there were huge losses, the state government paid a part of the cane price directly to the farmer.
Yeah.
So that's a possibility, and we are hoping that both the governments do respond to the reality, which is grim.
Okay. Vivek, good morning. So is it deja vu all over again? We have seen how sugar cycles work. Last year we were talking about record profit. Over the next 1 or 2 years, once you're out of inventory also, are we looking at completely different financials?
Yeah, Anuj, if you see what I've said and if you see the demand supply, you are in a spot today. You are in a bit of a fix. Having said that, it is not tough if both the governments act. If a part of the cane price burden is taken over by the state, if you do recall, you used to get about 40 rupees in the past when losses were huge. So based on a calculation of loss, if some part of that burden is taken over by the state government, if center comes in, pitches a little bit on the export subsidy side, industry puts in its best. So, if let's say the loss is 100 rupees, if 30 bucks is taken up by each or, something like that, I think the surplus scenario can be very well handled. Okay. So it depends on the action. If there is zero action, we are in trouble. And so is the arrears.
So since there will be quite a bit of pressure as far as sugar realizations are concerned, Mr. Saraogi, for the next few quarters, what do you think the average sugar realizations could be for the industry and for yourself?
Impossible to handle it. Would completely accept your statement that sugar realizations would be in pressure. Having said that, if the center acts, I don't know, then there could be a different scenario.
Okay, but what's ISMA's official plea to the center and the state for that matter, UP?
Sorry?
Any official plea that has gone
I didn't hear
from
your question.
Sorry, any official request that has gone from the Indian Sugar Mills to the UP government or to the central government?
Yeah, to both. And the crux of which I briefed you.
Okay.
We've requested center for exports, backed by some kind of loss mitigation, and we've requested center to state to participate in the cane pricing.
Okay.
As there is precedence of that also.
Okay. Thanks a lot, Vivek. Good talking to you, and we hope that there is some solution because it's an important sector, and of course there are a lot of stakeholders here. So not just from share market point of view, but otherwise as well. Markets then holding the lows of the day for sure, and the mid cap, by the way, from 1:25, which was really bombed out, now at about 1:12. So is there a trade here? Ashwani Gujral, Mitesh Thakkar and Sandeep Wagle with us. Ashwani, so at least intraday you think is it a long market? You want to play long, or do you reckon that this could be just a temporary lull before fresh selling resumes?
See, the average maximum range on the Nifty is about 150. It does more than 150 if there is some, big bad news. And here we are already sitting on 4 or 5 days of losses. So that way, it was expected there will be no follow through. And, on such days, often there is a bounce from the lows in all global markets, because as the markets trade, etc., somebody makes a positive statement and shorts cover. So my sense is that on the Nifty, IT, which opened down 200, that's now down only 43. And the stocks that we spoke about, Jubilant, Titan, those consumption pocket, they are already gaining and now are substantially in the green. So in terms of an index trade, if you have to take one, I think the banks are the slowest to show short covering. That is where still the opportunity lies. If you buy into the bank Nifty and it cuts its losses by half, I think that's where you should make money. Individual mid-cap IT stocks like Mindtree, etc., they are recovering. HCL, Infosys, all of these stocks are trading at highs. Even NBFCs like Bajaj Finance, Bajaj Finserv are recovering. So my sense is that from here you should be able to cut 50% of your losses if all goes well. In terms of you can buy into a Titan with a stop at about 880, target of 905. Jubilant Food is a buy with a stop of 2240, target of 2310, and Mindtree is a buy with a stop of 758, target of 775.
Are you taking any positional longs now, Ashwini?
See, positional longs are not possible because the overall trend is down.
Okay.
It's just that intraday we have our back to the wall and there's hardly any room to fall before we have a sharp pullback.
Okay. Mitesh Thakkar, Sandeep Wagle are also here with us. Mitesh, the market has not made any attempt to recover, at least in the first 1 hour. What does that tell you about the rest of the day, and what would you do with individual stocks now?
So I think I still haven't changed my opinion in the sense that yes, there can be a chance of a 40-50 point kind of a pullback, but I think as long as 10,050 is being captured again, I would not be very keen to explore the long side of the position. What we'll advise possibly is to tighten your stop losses on the short side. Maybe, you know, if you've been short in multiple lots across stocks or indices, cover 40 to 50% of your position and tighten the stops on the balance. So I still will need more evidence on the upside to possibly take long positions. But for the time being, I have two sell calls. I have a sell on DLF with a stop at 211.2 with a stop with the target of 197. And Piramal Enterprises is a sell with a stop at 2470 for targets of 2300.
Okay, Titan is in the green now, Britannia is in the green, ONGC and Infosys as well. So that's also the place where the sharpest positives have come in the last 1 hour, the rebound.
Yes.
Good morning, Sandeep. Your trades at 10?
Good morning, Lata. I would go with a sell in a Union Bank, stop loss of 90, target of 81. And a buy in a Jubilant Foods, stop loss of 2220, target 2310.
Okay, so Jubilant clearly is the one that's racing away right now. Ashwani, Infosys is making highs of the day. Any thoughts here? Of course, you spoke about Mindtree, but on the big boy Infosys?
See, it's clear that, you know, IT has found buying at lower levels. So if you are inclined to buy today, although the gain is not too much, but from the lows, the low was 1140. I think in case the market starts to recover, IT index will probably outperform.
Okay. Well, at the moment, of course, it does look like there is a bit of recovery. At least some short covering is clearly there in the markets. Down about 1.8 still the mid caps, but that's a distance from the 2.5% that it was racing to.
Bharat Dynamics listed, by the way, at a discount, which was always
15%,
expected.
I think.
Yeah, but it's now about
7%.
8%. So listing happened at 363, has moved on a bit. 396 is where it is right now. So things looking quite okay there. Ashwani, but just to get back to the market, then it's still a tricky market, right? Still down about 400 on the Sensex and about 120 on the Nifty, and still trading below the 10,000 mark. I'm just getting back to the point you made in the morning that today's gap down would actually become a big resistance for the market. Does that view still stand?
See, that's the problem with you know, my style, that often people think I have changed my view. What I am planning to do is take my 150 points on the Bank Nifty, and that's my long trade. The overall big downtrend remains. I don't expect the entire gap to be covered, but from 150 down, if you get to like minus 75, you know, that is my trade intraday. But the longer term trade stands, and chances are finally we will go down.
Okay. Well, gentlemen, thanks for that. We will keep coming back to you for more. For now, let's take a short break. We haven't done that in a bit. When we return, we'll focus on the metal space. There's been a big sell-off over there. Huge rise seen in crude lately. Paul Bartolome of S&P Global Platts and Amit Dixit of Edelweiss will join in.